Few days ago, I fell down a rabbit hole in a prediction market you probably heard of, Polymarket, or its rival, Calci. People betting real money on the weather. Millions of dollars a day across a variety of cities from Dallas to Paris. One trader turned $7 into the 640 betting on exact temperatures. The first time I saw this, I thought, wait, what is even to bet on? Everybody has a weather forecast. Government runs enormous and sophisticated models and hand the results out for free. Your phone already knows tomorrow's high. So if everyone has the same answer, where is the bet? What could a crowd of strangers possibly know that the forecast doesn't? So I scrapped a full year of these markets to find out. Are these people just gambling against the forecast they all share? Or can they beat the forecast? So what I want to test. Each market splits tomorrow's high into small ranges. 33 degree, 34 degree, 35 degree, and so on. And exactly one of them comes true. So, when the crowd picks a favorite, is it the one that actually wins? And the harder version. When the market says a bucket is 28% likely, does it happen 28% of the time? Short answer to both, yes. But I'm going to show you why that answer nearly fooled me, because for the first hours of the market live, the prices are complete noise. Let me show you exactly how I found that out. First, we need data. Polymarket runs 3 separate REST APIs, each doing a different job. The Gamma API handles markets and event discovery. That is where you search by tag, filter by date, get the metadata. The Clope API is the order book, prices, trades, the full tick-by-tick history. And the Data API covers user position and analytics, which I don't need here. So I built 2 functions. This one hit the Gamma API and pages through event with tag weather over a trailing year batch of 100 and upset until it runs dry. It hands back a clean data frame of events and one of markets. This one hit the Clope API for the full price history of a single market token. Every tick, at whatever resolution I ask for. Here I'm using fidelity of 30, so one price point every 30 minutes. 6,300 events, 64,000 markets. That is the raw data set, and weather is a messy tag, so it needs cleaning before I trust any of it. The weather tag is broader than it sounds. The data has hurricanes, wildfires, earthquakes, flu outbreaks. Turns out almost all of it is temperature, 97.5%. The weather market is basically a temperature market, so I keep that slice and drop everything else. And it's everywhere. New York, London, Paris, Seattle, Wellington, São Paulo, Cape Town. More than 50 cities. New York alone has 365 of these markets. One for every single day of the year. Then the fast cleanups. Filter market down to the temperature events, drop placeholders that never got a real condition ID, and derive who actually won from the resolved price. And one check that matters. Every event has to resolve to exactly one winning bucket. 0 winners or 2 winners isn't a result. It's a glitch, and I don't want to glitch voting. 19 bad events removed. Approximately 63,000 clean markets. That is what we're working with. Now the prices. 30-minute snapshots for all 6,000 events. Due to the volume, pulled asynchronously from the Clope API. 7.5 million price points. The goal from here is simple. A complete, clean dataset. No duplicates, no gaps. First problem. Some 30-minute windows have 2 prices in them. This is because 2 raw ticks happen to around the same time slot. When that happens, I keep the latest one and drop the earlier. Second problem. Some buckets are missing a price at certain timestamp entirely. Gaps in the pool. So I forward fill each bucket across the complete 30 minutes grid for its full open to close window. Then I did a quick check and make sure that only gaps filled, nothing gets removed. No duplicates. No missing prices. Now we can build the one feature this whole video runs on. Now let me show you the one metric that drives everything in this analysis. If these bucket prices are honest probabilities, then all buckets for a single day have to add up to 1. 100%. Something has to happen. Real probabilities sum to 1. And that is the whole idea behind prop sum. Group by event and the timestamp. Sum the prices. I'm calling it prop sum. And this column is a true detector for everything that follows. When it sits near 1, the market is behaving. When it's nowhere near 1, then watch. I also flag each market's very first observed price, so I can look at the exact moment one is born. When a market first opens, there are no real traders. It is bots and market makers setting prices, so the board isn't empty. And the prop sum shows it immediately. Look at the opening prop sums. 1.49, 1.63. The market is telling me there is a 163% chance of something happening, which is basically impossible. Picture 11 buckets, all opening in 25 cents. 25 times 11 is 275. These are not real prices, it's just placeholders. Same story as the picture. X-axis is how many buckets the market has. Y-axis is the average opening price of one bucket. If these were honest, an 11 bucket market should average about 9 cents, 1 over 11. There is a faint version of that. By 11 buckets, the clown drifts down towards 10 cents. But look at the spread, it's enormous. The 7 bucket markets pile up nearly 50 cents. Nowhere close to honest. So I can't just trust the opening prices at all. The early favorite is just a bot's placeholder. So the question changes. It stops being, is the market right? And becomes, when does it become right? I created a logic for the moment the market wakes up. I call it inception. Bots step back, real crowd takes over. The giveaway is that the prop sum rule snapping into place and staying. Buckets have to sum up to roughly 100%, from 90 to 110. And stay there. 6 consecutive checks, every 30 minutes, 3 solid hours. One reading could be luck. 3 hours is the crowd showing up. And one edge case to handle. At the very end of the market, prices start adding up to 1 by themselves. Not because traders go smarter, just because the market is closing. So when any bucket hits 95 cents, I cut it off. By that point, the outcome is obvious, and I don't want to count it. I disregarded 430 markets because they never converged. There is no clean way to spot when the crowd took over. That leaves 5768 where I can point to exact moment the crowd took over. Let me run one. Madrid, March 19. 11 buckets. 13 or below up to 23 or higher. First few hours. Lines wobbling, prop sum in the bottom panel bouncing around the nonsense. Then it slides into the green band and locks. Red line, that is inception. And right at the chart line, the crowd's favorite is, you can read it straight off the chart. It's right there, no graphic needed. And that is what we are testing. Did the crowd's favorite turn out to be right? This is where all data cleaning actually pays off. For every event I take the top priced bucket at inception. That is the one the crowd believed in most once the real trading actually started. Taking a random example. You can see the crowd picked 17 degrees as a favorite and 17 degrees is exactly what happened. Now let's see what happened across all 5768 markets. It is 40%. To put that in context, if you just picked a bucket at random, you'd be right 10% of the time. That's the baseline. The crowd is right 4 times more often than that. These are strangers on the internet, betting on exact temperatures, and they're getting it right 2 out of every 5 tries. But picking the winner is only half the story. The harder question is whenever the odds themselves actually mean anything. Let's figure that out. A sharp market shouldn't just pick winners. Its odds should be accurate. A bucket priced at 70 cents should win about 70% of the time. So I bin every bucket by its inception price and check what fraction actually won. The technique I'm using here is called the Brier score. It measures how accurate probability predictions are. The lower the score, the better. Zero means every prediction was perfect. If you just set 50% on everything, basically no opinion, you'd score 0.25. This market scores 0.069. That is a lot closer to perfect than to guessing. And here's the part I didn't see coming. Run your eye down these two columns. At the top, low prices. Predicted and actual are basically identical. 0.03 and 0.02. 0.15 and 0.14. Dead on. But at the bottom, when the crowd gets confident, they split. A bucket priced at 65 cents wins 76% of the time. Priced at 85 wins 94%. Now think about what that means. The usual way a crowd fails is overconfidence, when everyone piles into the favorite and bids it too high. This crowd does the opposite. When these traders are sure they are more right than their own prices admit. The favorites are underpriced. The market isn't arrogant, it's too humble. So, does the crowd knows tomorrow's temperature? Once the real traders show up, yes. The favorite wins 40% of the time against a 10% random baseline. And when they're confident, they actually underestimating themselves. The only catch is the first few hours, that it's not the crowd, that is the bot filling empty slots. Thanks for watching and see you in the next one.